Hi, Anthony. That's here again. Hey, another great question that I get often is, hey, don't I have to have equity in my home in order to reduce my rate, in order to do a rate reduction refinance type of loan? And the answer is yes and no. It depends on your situation. Generally speaking, conventional loans, yeah, they always require that you have a certain amount of equity in your property above the value, or I should say lower than the value of the loan amount. So you have, in other words, there's room there. If something goes wrong, then they can still recover their money. When I say they, I mean the investors who fund the loans. So conventional borrowers, you can take a look at this site here. It's makinghomeaffordable.gov, and they talk about the Home Affordable Refinance Program, often referred to as HARP. And if you want to learn more about that, you can also contact me. But just to kind of give you an idea of some of the requirements, and this is conventional. I'm going to talk about FHA and VA in just a minute. You might be eligible for HARP if you meet all of the following criteria. First of all, the mortgage must be owned or guaranteed by Freddie Mac or Fannie Mae, and they actually put a tool on here, right here, to see if it's Freddie Mac, to see if it's Fannie Mae. So that's that's handy to have right there. The mortgage must have been sold to Fannie Mae or Freddie Mac on or before May 31st, 2009. So we're talking, about 4 years now. So if you got the loan after that, then you're probably not going to be qualified to take advantage of a HARP program. The mortgage cannot have been refinanced under HARP previously unless it was a Fannie Mae loan that was refinanced under HARP from March to May of 2009. Not sure what the reasoning behind that is, but that's just what they're saying. And the current loan to value ratio must be greater than 80%. In other words, you need to owe at least 80% or more of what the value of the property is. So if it's $100,000, you need to owe $80,000 or more in order to qualify for a HARP program. I believe that the idea behind this is, if you're at 60 or 70 or 50% loan to value, that they're not going to bail you out. Sell the house. There's equity, and you can make money. I mean, I believe that that's kind of the reasoning behind that. And the borrower must be current on the mortgage at the time of the refinance with a good payment history of 12 months. And that kind of goes across the board for all loan types. If you want to have get a rate reduction of any kind, you got to have a good payment history, because you still have to demonstrate your ability to, be consistent and make your payments. This isn't a temporary fix where you reduce your payment, but then don't make your payment for 5 months, and now somebody else has to deal with a distress sale situation. So you can go check that out. You can check out makinghomeaffordable.gov, and it'll give you some good information, or you can just contact us and we'll share the information that we know about it as well, and see what your situation is, and help determine if this is in fact the right program for you. If you're talking about FHA or VA, then actually the government, think about it like this. FHA and VA is government insured, where most conventional loans are not government insured in the same sense. Government insured, they say, hey, we don't care what the balance of the loan is. It's in the best interest to the borrower, the homeowner, as well as the government insuring agency, to have that borrower have the lowest rate possible on that loan. Because if you default on a government loan, well, then it has to be taken back by the bank, and the government has to pay that insurance money to the bank to cover their losses. So think about it like that. Conventional, on the other hand, is generally a group of investors who have pooled their money together and have said, we're going to put this money into the market and make it available for people to borrow to purchase homes with, and over the long term we're going to realize the interest that we're gaining off of that. And there's a whole bunch. We can get super technical on all that, but think about it like it's a person, and you go to that person and you say, hey, can we reduce our rate? We're good on our payments. We've made our payments for 12 months. Would you be nice enough to reduce your rate? And their perspective is, heck no, man. I'm making a ton of money having a higher interest rate on you. Absolutely not. I mean, it's kind of a crude way of putting it, but that's in a sense really, if you look at it like that, then that kind of makes sense. So, FHA, VA, no, you can be a little upside down on your property and still qualify to have your rate reduction with limits. It's all dependent upon the bank that you are dealing with. And I know for a fact that the bank that I work with, some of the most generous guidelines as far as that goes. That's out there. I haven't seen anybody else who's as generous on that area as we are. So anyways, if you like us to review your situation, my contact information is here somewhere on this page. You can feel free to call me, and I'll take a look at your situation, see if we can help you out, because we'd love to do that for you. So hey, anyways, have a great day. Anthony Nitz. We'll talk to you real soon.